Let's now look at the last way of and the fifth way of doing the financial fraud, which is improper asset valuation. So in the balance sheet, if you will see, you will have a balance sheet which is full of things. Like for example, here you will see the company has a asset, then company has account receivable, then the company has inventory. They are assets and inventory and account receivable all has some kind of valuation, which is can be improper. The how the improper can be there. So inventory valuation, as you will know, usually involves the formula for weighted average or first in first out or the last in first out. Usually the financial reporting standards require the company to adopt one accounting method, can be last in first out, or it should be normally, oh sorry, first in first out, or the weighted average method. So the company, instead of following either of the two methods, may be using the LIFO, last in first out, or any other method of inventory valuation, which is not inconsistent with the accounting principles, which may help them to inflate the inventory valuation. Or the company may not be the putting the normally there is in inventory. If you have seen IAS 2, it requires to value the inventory at cost or net realizable value, whichever is lower. If the management knows that the net realizable value of the inventory is already low, but the management is not putting that value as a inventory valuation, in fact they are using the cost method only. So it's the auditor's duty to check if the inventory which is lying in the records is really recoverable at the cost or not. The how they can do that, they can cross check with the market price of the raw material, or they can cross check with the market price of the or the reselling price of the final product which is made out of those raw material, to see if the inventory need to be recognized at lower value or at the cost value, right? So or sometime maybe the inventory is obsolete, is out of fashion, is already obsolete, is damaged, but the management has not charged that amount to the valuation and reduce the value of inventory. So in that case the inventory valuation can be much higher. So that is one way of the valuation. The next part is the account receivable. Now, account receivable, as you know, depends on the realizability of account receivable, right? So the normally the company has to make a provision for doubtful debts, which means you have to say, okay, how many percent of my account receivable I will be able to collect. Prudent justifiability says you have to look at your past track and say, okay, how many bad debts you really have in the past. If you don't have any, maybe still you still out of prudence, you still have to maintain some amount as the provision for doubtful debts, because the new accounting standards requires it, but the company may not do that, right? Or there may be overdue accounts for more than 3 months, 6 months, 10 months, but the company still value them as full because they think that there is no reason for them to devalue the account receivable. Maybe the company may have to spend money on to recover the account receivable or to collect the money, but they don't recognize that as a expense, or they don't recognize reduce the value of the account receivable. So that's again a case of improper asset valuation. And the next is the fixed assets and business combination. The business combination is a bit more complicated, where you have a lot of mergers and acquisitions. You may overvalue the acquired company and recognize a very high value of assets and also the goodwill, and a very high value for of a low amount of goodwill, so that you can show a better picture of your total assets. Or maybe you recognize the less value in the fixed assets and more amount in the goodwill, so that your return on assets ratios are not impacted. So that is one way. And the fixed assets usually, as you know, normally has to be valued and has to be displayed at the cost. right? Or the had historically and normally does not change unless you do a valuation every year, because accounting standards allow the company to use the method of fair value, which is have to be done every single year or every 2 years at most. But the company may not be doing it, or maybe carrying the fair value at very high price, or may get the valuation reports done at a higher value without following the fair value principles. So auditors usually are very careful in accepting the valuation reports to value the fixed assets, because it may impact the company's value significantly, right? So these are the improper asset valuations. Now, how do you understand the red flags? The red flags here is again the cash flow, because even though you may inflate the value of assets, it does not inflate the cash generated from the operations. So if the cash generated from the operations is negatively impacted or is still negative, then the valuation of assets is not going to be justified. You may want to see the continuous profitability or carry out the DCF valuation for the business as a whole to justify that the total assets value is really in line with the income approach or the cost approach of the business in total, or there is a significant decline in the customer demand or business failure either in the industry or the company as a overhaul. It won't justify the higher asset valuations. Or maybe they involve a significant justificate estimates or subjective judgments that are difficult to corroborate. Maybe the way the depreciation is charged, so the method of depreciation does not have any standard regulation. So if the management is not able to justify the way they are charging the depreciation, means the valuation is not really the correct, or there is a non-financial management's participation in the preoccupation of the financial policies. Then again, it's a risk that the valuation are not done properly, because they're not management not the financial management experts who are doing the selecting the accounting principles and the accounting estimates. Or if there is an unusual increase in the gross margins, there's an unusual increase in the account receivable days, inventory days, the bad debts, or there's a unusual debt relationship between the inventory fixed assets and the accumulated depreciation, they all reflect towards the improper valuations. So these are the red flags which are happening in the fixed valuation. So now we have covered all the six aspects of the financial frauds: fictitious revenue, timing differences, improper valuations, and also the reducing the liabilities and underestimating the expenses and improper disclosure. So these are the methods in which the financial frauds are taken. There are standards which help the companies to detect the financial statements. So the auditor normally has so the SAS 99 AU 240 requires the auditors to have a response to respond be responsible for planning and performing the audit with a reasonable assurance to ensure that the financial statements are free from a fraud. So that's what the SAS 99 dictates. So the auditors need to make inquiries to the management about the risk, do carry out the risk assessment or the risk management profile. Are there any detection errors? Are there any fraud errors? Are there any internal control risk errors which may happen in the financial statements? Maybe there is one or more fraud risk factors are there. How the management is, does the management has a proper framework to carry out the proper risk assessment, or make sure that the financial statements are properly presented or not are free from misrepresentations? Is there any audit committee? Is the financial statements evaluated every few months to make sure they are not misrepresented. Are there any questions and answers from the audit committee on the differences or variances? Are they explained properly? The Is there any risk assessment done in the company, so that the auditors can understand understand what are the risks involved and how it has been managed. The other way of detecting the financial fraud, as we have seen in our examples, is really to do the financial statement analysis, vertical analysis and horizontal analysis, and the ratio analysis. Ratio analysis you can learn in my other course, where you will be able to learn in deep dive into the operational profitability, the asset utilization ratios, the liquidity ratios, and all other relations. So these ratios will help to understand the relationship between the balance sheet, cash flow, and the income statement, so that you can make useful judgments that if there is anything wrong, as I have demonstrated in few cases with the help of a dummy balance sheet that we have been presenting. So these are the methods in brief for financial reports, financial frauds. It comes with an experience and also with the careful analysis of financial statements. So if you have any questions, if you want to know anything about the specific financial fraud, you can always tell me. Thank you very much.